Good evening, everyone. Time for another silver update. This is a 4-hour chart of silver provided by netdenia.com. You can click on the link below. You can see we've got the bounce here and crossover that I was looking at. Rivals the next low. Actually, now is going to be the end of June at about that 26.50 price. Very, very near the bottom that I picked based on the divergence of the price and the MACD. So the bottom is still holding. Is this another intermediate bottom? As I pointed out last night, this is really only about 25% to 33% retracement, and but we're very low here as far as oversold conditions. So will we keep going from here? Possibly, or maybe roll over and go lower. Just have to wait and see. For the silver stackers, again, that's weekly or daily or monthly or dollar cost average. So you just want to look for the dips. Now, a pretty big story of the night, so I want to jump over to the questions real quick and then just dig deeply into the story of the night. The first question is from Thorn, and that's the CNY versus the US dollar. What is happening with these two currencies that causes you to predict a parity that should be parity in the future? Wouldn't trade be destroyed? Thank you. Well, I think what he's asking is that if the Chinese currency continues, and as I pointed out, we want to look at the cross rate, and we actually want to look at the CNY versus US dollar versus the US dollar versus the CNY. This one gives you a better idea. You can see, let's pull out to the daily. We're rallying. The Chinese currency is rallying, and it's almost to that 16-cent level. So it's broken out. It's going into new highs. Pull out to the weekly. We can see that the trend is a very, very long-term trend. Draw a trend line on it, something like that. So back to the question, what does it mean if we go to parity? In other words, 1-to-1. Well, it's my contention that we're going to that, and this gets to the main point about the type of beggar thy neighbor currency devaluations that we see going on across the world. I think it was the last interview with Miles Franklin. I believe it was either Sheckman or Randy Andy, or the new guy they have there, Bill Holter, I think is his name. But he's pointing out that we have this worldwide race to the bottom, something like we had with the last depression in the 30s, where we had tariff wars. This is kind of different because they're not raising tariffs. Instead, they're devaluing their currencies to try to support their exporters. So I think what's implied in this question is, won't the Chinese export market collapse? Now, I don't think that's necessarily a given, and you have to understand how these things work. Remember that if a currency strengthens against other currencies, that means it is difficult. The prices rise for their exports. Exports are at higher prices, but the imports that they bring in, such as the raw input costs, oil, whatever those are, so you have to do a calculation. You have to look at what are the costs to produce this good, whatever the good is. Let's just take some random electronic, the iPhone or something like that. So what are the costs going into that? How much petroleum is required to be imported? How much silver, of course, is going to be imported? How much of the raw materials are going into the cost of that? How much is the labor? And how does that impact the ability of that exporter to compete? So yes, prices rise as your currency strengthens on your exports, but your input costs decrease. So obviously, if oil is a very, very large part of the cost, then that's going to be a currency neutral sort of thing. So it doesn't necessarily mean just because a currency is strengthening. And in the past, for the last 100 or 200 years or so, it was a given and understood that any country wanted a strong currency. It's only under the recent Keynesian, universal Keynesian type of beggar thy neighbor economic model that it's a good thing to have your currency decline. In the past, it was always recognized that you actually wanted to have a currency strengthen. That shows the strength of your country. So I do not agree that just because the Chinese currency is going to strengthen, that they are going to be significantly weakened in their exports. There's a lot of things that they can do. The first one, of course, is to just manage those costs by having lower input costs as their import prices decrease. But also, if you look at the Japanese and their historical model, what the Japanese did was they increased the quality of the product they were exporting until, as you know, with cars, for example, you could take Nissan and Toyota, and those are going to be your top two, and Honda. Those are probably, in most measures, your top three quality cars. You could have some European cars thrown in there, but they have a very, very high reputation of quality. So it's not so simple as saying that a country whose currency strengthens is going to be destroyed on its exports. There are other factors that go in there, and you have to include those. And that gets to the next question, and that's going to be also about China, and that's from Noodles Doctor, and that's about China's dollar holdings. Hi, Brother John F. Firstly, thanks for all that you do. My questions concern China's dollar holdings. I understand that China holds 1.15 trillion in treasury bonds and 3.18 trillion in US dollar reserves. I'm not sure if that's an accurate figure, but we'll just go with it. If this is correct, combined the total is a whopping 4.33 trillion. Is it true that China can now bypass Wall Street to buy and sell treasury bonds directly? If true, this would mean we won't know if China was to dump treasury bonds en masse. This might prevent panic in the bond market for the short term, but what about the long term? Your thoughts? Well, I've held for the longest time that I believe that China is actually planning to write off, for the most part, but China's considering these bonds to be a write-off. Now, if you just think about the national debt in the United States, don't quote me on that, but I believe that under Obama, in the last 4 years, we've roughly doubled the national debt. I think it went from roughly 8 trillion to 16 trillion where we are now. So we're talking about nearly a doubling of the debt. So if that's the case, then in reality, if those printed dollars make their way out into the system, and I don't know how they can't, they're somewhere, then this 1.5 trillion is actually cut in half to about 500 billion or so. Now, if you add this figure in, and I don't know if that's accurate, but add them together, cut them in half, and then look at the future prospect of them being repaid, and you can see that it's potentially the case that China could just be planning to write this off. I think they see the writing on the wall. Yes, I think they hold the cards. They could probably explode the bond market. But then again, would the Fed be right there to suck it all up? And would we even know? So very good point. But I think you have to keep in mind that China knows what's going on, and they've probably already written down a very large percentage of what they're holding. And that probably accounts for the fact that China has been very busy in the last 10 years cornering natural resources, and they probably made tenfold the potential loss just by buying up natural resources on the cheap. So I don't think China is in any position to worry if their currency continues to strengthen and if there's a significant write-down on the debt that they hold. That's just the cost of doing business. Now, let's get to the main story of the night. And we're going to start off with a story from Wendy McElroy, and this came out today, and it's about Calpers. And so we want to really look at Calpers. Now, this is an interesting twist We're going to go into the figures a little bit here in a bit, but before we do that, we want to look at this latest grab here. You can see that the Bill 1234, and we're going to read this, is the latest attempt by the government, union, and of course their representatives, the Democrats, probably even a lot of Republicans, it's California after all, to prop up this legal Ponzi scheme known as Calpers. And we're going to show that in a bit here, but let's read this. And again, this is from Wendy McElroy. A huge pool of money lies just beyond the grasp of government's itching fingers, private pension funds. Various money grab schemes have been floated, including a legal requirement that all private pension funds contain a set of percentage of treasury bonds. The most innovative scheme comes from California, which is attempting to do an end run around the most powerful obstacle to a government grab, namely backlash from existing pension holders. What is Bill 1234? California Senate Bill 1234 creates America's first state-sponsored and state-managed retirement program for private sector workers. Because the scheme creates new pensions for non-union workers, however, it escapes the wrath of private unions and powerful corporations who would rebel if government grabbed at existing plans. The bill has already been signed by Governor Jerry Brown. The new system addresses private employers with 5 or more workers who are not already covered by an employer-sponsored pension plan. Such employers must arrange for an automatic deposit of 3% of the income of eligible employees into a government-run retirement plan. Well, first of all, I thought we already had a government-run retirement plan. We have Social Security, which is taking roughly 16% of your check. Oh, well, that's a Ponzi scheme, so we need something else. Well, then we have 401ks, and yes, a lot of these are not participants, but there are also IRAs that people can participate in, and that's independent. So something else is going on here, and let's keep reading. Employers can also make additional deposits on behalf of employees in much the same manner as matching 401k contributions. An eligible employee is defined as any worker who does not go through the process and paperwork to opt out of the retirement arrangement. Isn't that clever? Another sheeple shearing pen that you have to opt out. Otherwise, they're going to opt you in. Otherwise, the employer is opted in. Over 6.3 million California workers are expected to be eligible. Note, the bill allows employers to set up private pensions as an alternative, but this would be costly. Private sector retirement plans are regulated by the Federal Employee Retirement Income Security Act, or ERISA. This subjects employers to strict standards, complicated reporting requirements, and significant penalties. Small employers are highly unlikely to implement the private alternative. The new retirement plan will be administered by a board headed by the state treasurer, and it will select either a private investment firm or state's public pension system, the California Public Employees Retirement System, Calpers, to maintain and manage the new funds. So you can read the rest of the article. It's pretty clear here that they're trying to suck in the private workers into supporting this bankrupt Ponzi scheme known as Calpers. Let's go to her conclusion here. Very interesting observations. Bill 1234 may well make California go bust sooner rather than later. The infusion of cash depends upon continuing existence of small business. Shedlock, and this is a quote, she's citing Mish, Shedlock captured well the impact the bill would have on the sector. 1, immediate large-scale firings by small businesses. No small business owner in his right mind would have over 4 employees. 2, any business that would leave the state. 3, many businesses that do stay would be destined to go bankrupt. And 4, California would end up like Detroit or Greece. And so an excellent article. I encourage you to read that. So let's jump in and take a look at Calpers. This is the Wikipedia article. Calpers, California Public Employees Retirement System, is an agency in the California executive branch that manages pension and health benefits for more than 1.6 million California public employees, retirees, and their families in fiscal year 2007 to 2008. That's kind of interesting there. So the latest figures we have on this are 5 years old. Well, again, that's Wikipedia, so take that for what it's worth. 10.88 billion was paid in retirement benefits, and in calendar year 2009, it's estimated over 5.7 billion will be paid in health benefits. So let's use that figure. We're going to come back to that figure to try to put these numbers together. But before we do that, let's jump over and look here at the Calpers bonuses, because Calpers, you always hear your public employees talk about how they're not compensated as the private sector is compensated, so they need more money here. Well, we find out that Calpers actually pays out bonuses. So let's look at this here. This is from Business Week from 2011. The California Public Employees Retirement System, the largest U.S. public pension, paid its investment officers $4.4 million in performance bonuses last year, a 33% increase from the previous year. The $218 billion pension system gave bonuses of $100,000 or more to 16 employees, led by a $212,000 award to Tom McDonough, a senior portfolio manager in the fixed income security. So fixed income. So here's a guy who's generating, what, 2%? Something like that. I don't know. Fixed income. According to data released under public records request, McDonough was awarded prorated 14.5 months. Calpers earned 20.7% in the year ended June 30th. Of course, that's because they're coming from huge losses. We're going to see that in a second. So you can read the rest of the article. Calpers actually pays out bonuses. Now that's the most ridiculous thing I've ever heard. To have a public pension system pay out bonuses to the people who are supposedly investing in safe government bonds. What kind of investment knowledge does it take to invest in bonds? But of course, the whole thing's a big scam. So let's look at a PDF from Calpers. This is an official PDF, and it's more up to date than the Wikipedia. This is actually has June 2012, although some of the numbers are from earlier years. But we want to look at the raw numbers. Now, they say here on the background, the California Public Employee Retirement System manages retirement benefits for more than 1.6 million California public employees, retirees, and their families. As of June 30th, 2011, we provided pension benefits to 1.1 million active and inactive members. I don't know what that means. And 536,000 retirees, beneficiaries, and survivors. So let's take this raw number. Now, you'll have to take my word on it and do the math yourself, but if you go back to the Wikipedia, calculate out the amount of money, then you're looking at roughly $40,000 per retired member. That's the number I came up with. It's probably higher. Now, if you know the double dipping, triple dipping, that there's a lot of questionable stuff that was done as far as the calculation of the benefits, and you can dig deep. There's a lot of stuff you can research. But let's just do the easy numbers here. We've got 536,000 retirees. So let's bring out the dreaded calculator and take a look at what these numbers give us. So we know we have 536,000 retirees. And we're just going to use that round number of $40,000 a year. I think the number is probably a lot larger than that, but we'll just use that number. And remember, there's medical in there as well. Now, that gives us a payout of about $21 billion a year just for these member retirees, beneficiaries, and survivors. So keep that number in mind. We need to raise $21 billion a year. So let's forget about the pensions. The bonuses that the investment guys get, And let's drop all that out, but let's just look at the percentage returns that these highly paid Wall Street type geniuses who are getting anywhere from $250,000 to $500,000 a year to make decisions on where to invest Calpers assets. But of course, now if you go into the history, you know that initially it was only short-term and medium-term bonds they can invest in. Then they stretched it out to longer-term bonds. Then they stretched it out to 25% could be stocks, and then they lifted the cap and it's unlimited stocks, and that gets all the way into the CAFR, and we can't go there. We've already addressed that. But remember our 21 billion figure. So let's assume a 2% interest rate. Now, we know that they state something like 7%, and everybody knows that's laughable. In fact, I pointed out before on my latest Ponzi pension expose, which mentioned Madoff. If you remember, the judge in the Madoff scandal told us that anybody who promises you 8% or higher returns year after year is by definition running a Ponzi scheme. So, and Calpers is right up there. I think we're at 7%. But let's look at a realistic number. Let's say that we're paying out $21 billion a year, and we're getting 2% because we know the Fed's brought us down to 1 or 0 or whatever it is. So that's a real simple calculation. We just multiply times 50 because that's 2%. And you can see right there, $1 trillion in assets. That's going to be the amount of assets you need to pay these 536,000 retirees $40,000 a year. Now, we know from the numbers that Calpers cites, and they had a huge hit in their numbers. The huge hit brought them down below 200. They've risen recently, but you can see the peak value of assets was 260 billion, and they took a hit. So we don't know where they currently are, but my guesstimate is that Calpers is somewhere around 200 billion right now, maybe a little bit higher. So if we just do the math and assume a 2% return, and actually we're getting lower returns, and unless, of course, we get a stock market explosion, which we may if the Fed decides to print money to bail out all this stuff, then Calpers is actually underfunded by 80%. They have 200 or so billion in assets when they need about $1 trillion in assets to pay their current liabilities. Now that's probably the reason why they are trying to force private pensions. They're trying to force private employers into their public system, and you can read more of the details about how they're going to create two-tiered system and continue to guarantee those incredible payouts to the public employees and make the private employees subsidize that. So it's a gigantic Ponzi scheme. It's a Ponzi scheme that's going to go bust, and it's one that is now pretty clear with this latest move. They intend to do it at the expense of the private sector. That is what we've seen grow for the last 4 years under the Obama administration. We had the attempted recall of the governor in Wisconsin for even attempting to do any type of restriction on the growth of these public pensions. So as I pointed out many times, the whole thing is destined to bankruptcy. It's already beyond the Madoff level, and Madoff, actually, I think they've clawed back almost half the assets. So if Madoff is rotting in prison, then where should the politicians from California be in the future when this whole thing goes bust? And of course, that gets at the issue of why they're ramping up a police state. Well, I think it's pretty clear that when the public employees find out that the whole thing was a gigantic Ponzi scheme, and they're not going to get, probably my guess, they're not even going to get 10% of what they were promised, then my guess is those public employees are going to make the streets of Greece look like a springtime picnic when they hit the streets in violence. So back to the silver chart. Physical silver, physical gold, and possibly some cash. These are going to be the only reliable retirement as the paper Ponzi scheme goes up in flames. They're doing everything they can. Look for them to come after your 401k. Look for them to come after your ERISA pension. Look for them to come and try to force you into bailing out their pension system. And of course, the only rational reaction is going to be for you to quickly exit from these systems. Get as far away from these systems as you can. Don't plan on them having anything, because they're either going to pay you a tiny percentage of what's promised, or they're going to hyperinflate the promises away so that you can buy a can of cat food with it. And we'll talk to you next time.